Welcome to our webinar, How to Properly Insure Wraparound Mortgages, brought to you by insuranceforinvestors.com. A little bit about Insurance for Investors. We are an independent brokerage located near downtown Austin, Texas. We specialize in working with real estate investors. Currently, as of the time of this webinar, we do work primarily in Texas, California, Georgia, Florida, both North and South Carolina, as well as New York, with other states coming on board very, very soon. We specialize in investor-related insurance needs such as wraparound mortgages, vacation rentals, short-term property, vacant property, rehabs and flips, rentals and portfolios, commercial property, lesser's risk, professional liability, commonly referred to as E&O, and similar insurance-related products. We have numerous insurance markets that we work with, and we've insured literally hundreds of mortgage transactions, and we actually wrote the book quite literally on how to insure those. As myself, my name is Kelly Troy. I own the brokerage. I've been investing since the mid-1990s. I've owned apartments. I've done numerous rehabs and flips in numerous states across the U.S., and I'm very experienced with seller financing, both in brokering notes as well as seller financing my own properties in the past. I was also a traditional mortgage lender, and I own my own private hard money lending company for a number of years, so I'm very familiar with hard money lending as well. I've founded several real estate investing groups, and I've developed and taught many real estate investing programs. Now, today, this webinar may be a little bit long, but we're going to cover a number of topics specific to wraparound mortgages, one of which is the goals of all party involved, billing issues and escrow, types of homeowner policies, the differences between named insureds, additional insureds, mortgagees, and loss payees. We're going to talk about the role of the WRAP coordinator, which is a relatively new term we've come up with. Insurance scores and credit, how they affect insurance premiums and your buyer's ability to get insurance. Why premiums should not be the deciding factor in purchasing an insurance policy. We all know that they're a factor, they should never be the D factor, and we'll go through the reasons why. We'll talk about some of the required documentation, wraparound agreements, which is becoming needed more and more often, power of attorney, and an executed set of insurance documents. We're also going to discuss the role of the insurance agent or agency. This has gotten a little bit convoluted and has tended to cause some problems in insuring wrap mortgages, and we're going to clarify this a little bit. We're going to talk about how insurance coverage should ideally be addressed from the start of the transaction and some of the other common problems and issues that occur. But before we begin, we're going to be pretty blunt and have a little bit of straight talk for just a couple of minutes. These are things that are talked around but are seldom ever talked about. We don't want to offend anybody or hurt anybody's feelings, but you're listening to this because you want to know the good and the bad and the ugly about insuring and putting together wraparound mortgage transactions, and our goal is to give you the straight skinny on that. So starting right out, let's be clear. Wraparound mortgages are perfectly legal. They're legal. They've been done for quite some time. The acceleration, commonly referred to as the due on sale clause, is the biggest concern that all the parties have. Is the mortgagee going to find out about the property transfer and call the loan due? Because of this, all parties are attempting to transfer the property and avoid the underlying mortgagee. There's no nice way of putting it. The parties are trying to skirt the system a little bit, transfer the property from the seller to the new buyer, keep the underlying mortgagee in the dark so that they don't call that acceleration clause due. The reality is that's kind of much ado about nothing. We have done hundreds and hundreds of wrap mortgage transactions. We know others who have purchased or sold or worked as transacting coordinators on these type of sales. We have never, in our experience, as of the date of this webinar, August 20th, 2012, ever seen a loan actually called due. Everybody hears about it, but nobody has ever firsthand witnessed it. So is it theoretical this could happen? Yes. Is it likely? Probably not, at least not at this time. Banks and lenders are well aware of seller financing. It's a well-known secret and the elephant in the room. They know wrap mortgages are popular and that they're regularly used. As we just stated, we have not seen any lenders demand that the acceleration or due on sale clause be called due or exercised. As long as the loan is performing and they're getting payments, it is a non-issue. Now, having said that, this may change over time with reduced foreclosure backlogs and government regulations, but only time will tell. The bank's lending department is often several states and many years away from where the actual loan occurred or the insurance is maintained. The loan may have happened 5 years ago somewhere in Texas, and the loan servicing department is with another company or another division based out of Utah, and the insurance staff are usually just administrative data entry clerks that wouldn't know an additional insured from a mortgagee, and their job is to simply make sure that they get a piece of paper with the seller's name and that it's updated in the lender's computer system so they know the property is insured. Most times they don't even look at these. In the event that acceleration clauses are ever an issue in the future, the properties that are more than likely going to be targeted first are those that have good equity positions and low interest rates on the existing loan. That way the banks are going to take back those properties. They walk into it, they have good equity from the get-go, and that money that they're lending out at 3 or 5 or 6%, they may be able to turn around and loan out at 7, 8, 9%, depending on what the state of the economy is at that time. So in the event that acceleration due on sale clauses ever become an issue, more than likely those are going to be the properties that are looked at first. Now, continuing on with this, the whole point of this webinar is to talk about insurance. And insurance is complicated. It's not a commodity that should be purchased based on who's cheaper. That is going to get all parties in trouble. An insurance policy is a legal contract between the named insured, also referred to as the policy owner, and the company actually issuing the policy. Cheap insurance often equals expensive problems. You see I have that bolded. There is a reason for that. You get what you pay for. It is very, very true. There is no one-size-fits-all insurance policy in existence, period. Policies, coverages, and pricing vary greatly from one company to another. You go to 3 different insurance companies, you're going to get 3 different prices because they have 3 different policies that may be similar, but one is going to cover X, Y, and Z. The other one's going to only cover X. The other one's going to specifically exclude coverage for X, Y, and Z and then have even more caveats. You as a consumer or as a non-insurance professional more than likely are looking at this as a gallon of milk going, well, they're the same thing, so who's cheaper? Insurance policies are absolutely not the same thing from one company to another, and what's covered and more importantly what's not covered is going to vary tremendously across companies, and it's not until an issue occurs you find out that difference. There are numerous legal considerations involved in issuing an insurance policy, and quite frankly, independent agents and or agencies are often better choices than captive agencies. Independent agents represent a number of companies. Insurance for Investors is an independent agency. We have contracts with numerous insurance carriers across the United States, and we're able to actually go out and shop for what is the best insurance solution at the best price for a specific situation. A captive agent often works for your well-advertised, well-known, well-branded companies that advertise on TV and radio. They, by contract, can only offer the product of that company. You can have any color you want as long as it's black. It doesn't matter how much it costs or if it's the right solution or not. If it's the one they have, that's the one you're going to get. Other captive agents may be allowed to go out and shop some other limited markets if the company that they're with either doesn't have a policy to fit your need or really that's the only situation. So independent agents have a lot more latitude, generally a lot more experience, and a lot more knowledge than captive agents and agencies. Having said that, many agents have little or no investing experience or knowledge, period. They may own their own home, and that's it. They've never owned investment property, commercial property. They're not familiar with real estate investing. And because of this, more often than not, they issue policies incorrectly or in violation of insurance code or contract law. Not to be derogatory to anybody in the insurance profession, but many people are salespeople whose primary objective is to get business on the books, sell policies, meet quotas, and they may or may not truly be versed in their industry, and they may know nothing at all about insurance for real estate investors and related risks. Many investors, investing gurus, and realtors also assume that because they know something about real estate that they're also de facto insurance professionals. And people love to give advice. Doesn't matter if it's correct or illegal. They'll give it all day long. Being a real estate investor doesn't make you or anyone else an insurance expert any more than being a mechanic makes that person an expert at working on NASCAR Formula One vehicles. Realtors, same thing, may be excellent at their position as far as transacting real estate sales, showing homes, marketing and positioning homes, working with buyers and sellers, but they're not insurance professionals. They don't have an insurance license and they don't work in that field. And the reason I harp on this so much is this is where a lot of problems occur. People get bad advice, they follow that bad advice, and then problems occur later down the road. You should always consider the source. Which brings us to our next slide. You should never take insurance-specific advice from an attorney. Attorneys may know a little bit about insurance, but attorneys generally practice in a specific field: criminal law, civil law, domestic family law, real estate law. But they themselves are not licensed insurance professionals. They do not have contracts with various insurance companies. They do not know the underwriting guidelines and appetites of these companies. So they are not qualified to give specific insurance-related advice. We already talked about realtors and real estate professionals, maybe very, very good if they do, but they're not qualified insurance professionals. Other investors, I myself am an investor, and I love to talk with other investors, and we share resources and ideas and experiences, but other investors are not qualified to give insurance advice. Financial advisors, same thing. The only caveat to that may be in the realm of disability insurance, life insurance, or insurance-related products such as annuities and such, related specific to their position as a financial advisor, not property and casualty insurance. Friends and family members, great to talk to, bad to take advice from. And finally, that third party we always hear about. Your second cousin's aunt who's married to your neighbor's best friend, stepson, told me that once they did this and that's what worked for them. Don't take that advice from anybody unless he or she has an active insurance license. They have real-world experience, and the advice is probably going to be incorrect if you do. Take it from a source other than that. You wouldn't take legal advice from a landscaper, so don't take your insurance advice from anyone except a truly experienced licensed insurance professional. Now, continuing to be blunt and straightforward, all parties in a wrap mortgage transaction, for obvious reasons, want to get the transaction completed while skirting or going around the underlying loan and traditional mortgage system. However, unlike that underlying mortgage, an insurance policy cannot be skirted around, made to fit, or compromised simply to fit the transaction because everybody in the transaction wants it to be. It doesn't work that way. Insurance policies are legal contracts between the policy owner, also known as a named insured, and the issuing company. There are issues of material misrepresentation, which is a very, very, very big issue. The concept of insurable interest. You have concerns of policy eligibility, underwriting guidelines, and the carrier's appetite for business, as well as professional licensing issues for the agent and or agency actually providing that coverage. Now, we touched on a material misrepresentation, and this is very, very important. Defined, a material misrepresentation is a deliberate hiding or falsification of a material fact, which, if known to the other party, could have aborted or significantly altered the basis of a contract or transaction. That's an insurance policy. An insurance company provides coverage and issues a policy based on information that is provided on the application for insurance, whether that application is filled out by the insurance agent or broker based on information obtained over the phone or email, or if it is the policy owner completing that application himself or herself. A misrepresentation need not be intentionally false to create liability. We've all heard that ignorance is not an excuse, and that is very true. A statement made with conscious ignorance or a reckless disregard for the truth can create liability. Non-disclosure of material or important facts by a fiduciary, such as an insurance agent or legal professional, can result in liability. Meaning, a policy may be issued with incorrect information on the application, but in the event of a claim, an audit, or any other such issue, all parties can be held liable for that, and there could be large issues that occur later on down the line. Insurable interest. Insurable interest is the underlying foundation and concept underpinning all insurance law. In the law of insurance, an interest by the insured party in the value of the subject of insurance, including any legal or financial relationship. Insurable interest results from property rights, contract rights, and potential legal liability. There are various degrees of insurable interest, whether you are the actual property owner, a mortgagee, and additional interest. We'll go into those later. But the insured party must have an interest in the subject matter of his or her policy, meaning you can't take out an automobile policy on your next door neighbor's car because you don't own that vehicle or have an insurable interest in that vehicle. Otherwise, such a policy will be void and unenforceable since it will be regarded as a form of gambling, meaning if you took out a policy on your neighbor's car that you don't own and he or she got in an accident and that vehicle was considered to be a total loss and you benefited from that insurance loss even though you didn't have an interest in it, you gambled, you won, it's now considered insurance fraud. Well, subject to versus wraparound mortgages. Words matter, and these two terms are often used interchangeably and synonymously when used in conversation. However, they are very different things, especially in regards to how an insurance policy should be issued. A subject to transaction is one in which a buyer takes ownership of a property, quite literally, subject to any existing mortgages or liens. The buyer steps into the seller's shoes, accepts that underlying mortgage, and starts making payments. The seller is not carrying back any type of second mortgage, promissory note, or any other type of financing. They're just wanting to get out from under the deal. The new buyer is taking it over. In a wraparound mortgage, it's a little bit different. The buyer is purchasing the property. However, the seller is carrying back a second mortgage. So the buyer purchases the property subject to the underlying loan that's already in place. However, the seller also takes back a second mortgage in an amount greater than that underlying loan. So the seller owes, for example, $100,000 but may sell the property for $120,000. The buyer accepts the underlying $100,000 loan, plus the seller carries back a $20,000 second loan as well, so that the new buyer has a debt service of $120,000. The buyer pays the seller pays his or her underlying monthly debt service, and keeping any positive cash flow as a profit. So it's a subtle difference, but it is a difference, and it does matter with insurance. Now, let's talk a little bit about the parties that are involved in a wraparound mortgage transaction. The lines get blurred here a little bit, and communication gets muddied up, and this is where the issues really occur. First of all, we have the buyer. The buyer normally has money for a down payment, 5, 10, 15, sometimes even 20% or more. But he or she does not qualify for a traditional mortgage loan for any number of reasons. More often than not, the buyer is unsophisticated or inexperienced with purchasing real estate. This may be his or their first home. And the buyer often has poor credit scores or past money management issues, which is why they can't qualify for a traditional loan. This may be related to family issues such as divorce, money management issues resulting in foreclosure or bankruptcy, or they could all stem from an extended term of unemployment due to layoff or relocation. The seller often needs to sell a property due to a potential foreclosure, such as a short sale situation. They may be, or he or she may be relocating and need to sell the property, and it's a market in which that's not happening. Or they may have a problem selling due to people wanting to purchase the home, but it being in an area where those potential buyers, as we just discussed, are unable to obtain a mortgage loan. So you have somebody who wants to sell a home, somebody who wants to buy a home, but the party that wants to buy it can't get financed for it. The seller also does not want a stream of payments. He or she is not interested in collecting a 20-year mortgage loan. It's very common to have a 2-year balloon payment where a wraparound mortgage has a 24-month balloon payment, the idea being that the buyer in that 2 years has cleaned up credit issues. They now have a 2-year track record of on-time payments, and they're actually refinancing the property as opposed to actually doing a first-time purchase. The coordinator is a relatively new position. The WRAP coordinator is the party that brings the buyers and the sellers together. They want the deal done as quickly and easily as possible because he or she gets paid when the deal is transacted. This person may or may not be a licensed realtor, maybe a private investor, and the actual experience level varies. This person may have done 500 wrap mortgages, or this person may be doing their very first one. So the experience level varies, and again, there's often information that he or she has gotten from all types of disinterested third-party sources that may or may not be qualified, so they may be running on information that's not accurate or that conflicts with other information. And because of this, the coordinator, unfortunately, and not to ruffle any feathers, but is where 90% of the self-created insurance problems actually arise. Because the coordinator wants to control the transaction to make sure it gets done, but they try to control aspects of the transaction that he or she is not familiar with or an expert in, and because of that, steps are missed and things occur that lead to problems later on. Now, the rep coordinator often manages most aspects of the transaction, which is what we just talked about. In many cases, they should have some sort of limited power of attorney for the buyer if the buyer is the party that they are representing. Again, it's because they use advice and services from other investors and professionals, such as appraisers, attorneys, closing coordinators, and insurance professionals. However, going back to what we stated just a few moments ago, the coordinator often argues, for lack of a better term, the professional insurance advice given by individuals such as myself because they have heard third-party information that conflicts, and the information that we may be giving them is not what they want to hear because it makes the transaction a little bit more difficult. And it's human nature. People want to hear what they want to hear, not what's true, but what's easy. And again, this is setting up problems into the future. So you either deal with it right on the front end or you deal with a whole bunch of wrong on the back end. Now, the coordinator often and unfortunately tries to control communication with the buyer and even the seller at times. This leads to unforeseen liability for all parties because we all know how stories change over time. Every person that tells it, it embellishes or something gets left off, and things change and get muddled and lost in translation. Doesn't mean it's intentional, it just means it's going to happen. It creates errors and omission issues for the agents as well as many other issues related to the insurance. This person may also not even have the legal authority to work on behalf of the buyer or seller if there's no power of attorney or contractual agreement between the parties. So while this person may be doing what he or she thinks is right and trying to make the transaction go easy, may be doing a whole lot of wrong at the same time. It's a disservice to both buyers and sellers, and as we just alluded to, good intentions often lead to very, very bad results. It doesn't have to be intentional to be unfortunate. Now, the insurance agent or broker, this is where there's a lot of gray area, and a lot of agents themselves give very, very bad advice because they're not familiar with real estate investing, or they're more interested in getting a sale than doing it correctly. And it doesn't mean that there's any malice involved. It just means that there's a lot of misinformation out there. And so it needs to be clear what the responsibilities of the agent or broker are and what they are not. The insurance professional dealing with a wrap transaction is responsible only for issuing the correct policy and issuing that policy in the correct manner. Not responsible for how the parties choose to set up the transaction, what the agreement is between the parties, whether or not the loan is going to be serviced and escrowed, how billing is set up, or any other transaction details. We unfortunately tend to get drawn into that quite often, but that is not within our true scope of responsibility. Insurance agents and brokers are also not responsible for chasing payments to avoid insurance cancellation. Going back to the line above, if the transaction is not set up correctly on the front end, if it's not escrowed, if the bills aren't paid, it's not up to the party issuing the insurance to spend days, hours, or weeks chasing payments so that the insurance isn't canceled and the underlying mortgagee doesn't find out. This is a responsibility of the other parties. The insurance agent's broker has a legal and contractual duty to the insurance carrier, meaning we actually have authority and responsibility with the companies we represent. We have a legal responsibility to them to provide good risks and issue coverage appropriately for their guidelines and underwriting eligibility and appetite. We also have a duty to the named insured, the policy owner. he or she is the one that's always going to call in and file the claims, request cancellations, get refunds, and deal with the policy. Now, we work with the investors, sellers, coordinators, and those that refer business, but our legal duty is to the insurance carrier and the named insured and not anyone else. That's why we should always be allowed to communicate directly with the named insured. Again, things get lost in translation, and future litigation can result. Brokers and agents are also bound by law, industry code of ethics, and the company guidelines and underwriting requirements for the companies that we work with. And quite frankly, the insurance agents or brokers should not be expected to risk those contracts, litigation, or any other consequences because wrap transactions are not set up correctly. Now, some of the things that we insurance professionals risk are losing our licenses, receiving monetary fines, which could range from a $500 fine to a $50,000 fine or more, various disciplinary actions for the various state insurance departments in which business is being conducted, losing those carrier contracts that we keep mentioning so that we're no longer allowed to do business with them, and all the money that may be placed with those carriers gets lost as well, so there are very large financial concerns there, and suffering errors and omission suits from the parties, all that for the sake of an $800 policy that isn't issued correctly. That's why it needs to be done very, very carefully and correctly from the beginning. Now, the insurance agent or broker can suffer those consequences for knowingly making false statements on an application for insurance. Remember the concept of material misrepresentation that we spoke about earlier? That's it. Misrepresenting the actual risk for the company issuing the policy. Knowing that the risk is one thing, but actually stating on the policy that it's completely something different so that it fits within those guidelines for the carrier and they'll issue coverage. Issuing false or knowingly incorrect insurance documents. Evidence of insurance with incorrect named insured information, so it gets sent to the mortgagee and the buyer and seller are happy, but now we just falsified insurance documents, and in the event of a claim or audit or some other issues, depending on the situation, could theoretically be considered fraudulent. Agents can get in trouble for issuing the incorrect type of coverage for the risk, the wrong policy type, homeowner's policy for a rental unit, renter's policy for a homeowner's, and such, and mismanaging insured's funds to pay for insurance premiums. Now, it's our fiduciary responsibility. And again, ignorance is not a defense. You can't go into court and claim, well, I didn't know, and everybody shrug their shoulders and go, oh, well, okay, well, it's better now. That's not the way it's going to work. Now, as an example, this is something that has occurred rather recently. There was an insurance policy for a wrap mortgage transaction that was issued absolutely correctly. All parties were listed in the correct position on the policy. The policy was sent to all parties. Evidence of insurance was sent. Everything was done correctly. The named insured client chose monthly EFT billing. He or she did not have the money or claimed not to have the money to pay for the insurance all at once. Therefore, they wanted to be able to pay through electronic checking draft every month. The transaction was closed. Everything was sent over. Everybody was happy until a few days later. The agency was contacted by the client stating that they needed a paid in full receipt to provide to the closing office so that the closing office would fund the transaction and pay the seller. They couldn't do it unless they had a paid in full receipt showing that the insurance was in force and paid for the year. This requirement for paid in full coverage was never mentioned to the agency prior to the policy being issued. And the client was upset because the agency couldn't provide this receipt because, in fact, the premium was not paid in full. It was being paid in installments. And in order to get this receipt, the remainder of that premium had to be paid in full before it could be issued. This was a completely avoidable issue. The agency had never received formal closing instructions from the party, and the insurance requirements were never really set forth from the start. It was a very loosey-goosey transaction, unlike a transaction normally held by a traditional lender at a closing office. So these are some of the examples that come up that the insurance agent or broker is not necessarily responsible for. We work based on the information that we receive. Now, at the end of the day, the seller is the party with a financial obligation or promissory note with the underlying lender. They may have transferred the equitable and or legal title to the property, but the underlying mortgagee still has a promissory note with them. The seller, at their discretion, could choose to inform or not inform that underlying lender of the property transfers. That is a decision that he or she makes for themselves. The insurance company, on the other hand, has a direct obligation and responsibility only to the buyer or named insured policy owner, period. The insurance company is in the business of insuring the subject property for the owner, which is the new buyer. And that company is not going to make special exceptions in their established guidelines for the other 4 million policies they have simply to issue an $800 homeowner's policy for this transaction. They're not going to do it. And the insurance company is not responsible or even willing to fabricate false information or documents for the benefit of the seller or other parties so that the underlying lender is not informed of the transfer. In other words, the insurance company is not going to commit fraud and change the way they do business so that the parties can do a wrap transaction. If that is the major concern and that's what the parties want to happen, my advice would be do not do a wraparound mortgage. Now moving on, we're going to talk about the big issue where most of these problems culminate and come to a head and where things occur, and that is with billing and escrow. This is the Achilles heel of wraparound mortgages that everybody's probably been waiting a little bit to hear about. This is a number one issue with insurance because A, it's rarely set up correctly by the parties in the transaction. And by parties, I mean buyer, seller, wrap mortgage, coordinator, attorney, and closing office. It's usually only thought of after the property has been transferred. It's like putting on a seatbelt after the accident's already taken place. The parties want the insurance to be set up the way it's most convenient for themselves in the transaction, but not how it's really supposed to be under terms of insurance law and carrier guidelines. We want it the way we want it. We don't want it right. All parties are trying to work around the underlying loan and hide the sale from the mortgagee, but still expect the underlying first mortgage to pay the bill for the new owner as if nothing at all has changed. This is somewhat unrealistic. We want to change the terms of the loan. We want to transfer the property. We want to change all the documentation, but we still want it to work as if nothing has ever happened. Maybe, maybe not. It depends. There's a little bit of luck involved in that we'll go through. The parties assume that the mortgagee, the underlying mortgagee, will continue paying the insurance premium from escrow. However, there are a couple of problems. A, there's no guarantee at all, period, that that mortgagee is going to pay the new buyer's premium from the seller's escrow account. Remember, that escrow account is in the name of John and Mary Smith. The new buyer may be Mark and Darlene Jones. Well, there's a very good chance that the lender is not going to pay one person's bill from another person's escrow account. They may not. Again, they're aware that these transactions are taking place, but they're not obligated to make that payment. So if they don't, what's your plan B? This goes back to insurance agents chasing payments. The mortgagee chooses not to pay the bill. It's not up to the insurance folks to spend the next 3 weeks making 47 phone calls back and forth chasing money on a policy they made $80 on. So what's the plan B? Payment problems can occur at renewal. So let's say that the premium is paid in full at closing. Everybody's happy. The first year is great, but then that renewal bill goes out for the insurance. Who is that renewal bill being sent to? Is it being sent to a new escrow account that was set up for the buyer at a loan service company? Is it being sent to the buyer directly to pay individually? Is it being set to that mortgagee? Well, if the mortgagees, say for instance, maybe paid it the first year, doesn't mean they're going to pay it the second year. You never know who's going to look at it, who's receiving that file, or what they're going to say, or what's changed internally. So it's always a risk. This is inherent with wrap mortgages, and there's nothing that can be done about it. What if the loan servicer changes or that loan is sold in the meantime? How does that get dealt with as far as payment? You can't ever assume that it's going to work the way you want it to work simply because you want it to work that way. Now, loan servicing and insurance billing. Here is how, in a perfect world, which I know none of us live in, but in a perfect world, how it should be set up. A wraparound mortgage closing between a buyer and a seller should be no different than the closing set up between the seller and their initial lender when they bought the home from the front end. There should be a new secondary escrow account set up for the new buyer. Prior to closing, that escrow account should be in the buyer's name and with a third-party loan servicing company. Now, you're going to ask me a question. Well, doesn't that mean the buyer's paying for insurance twice because there's another escrow account? Yes and no. We'll talk about that later in the presentation. That buyer, ideally, should, just like in a regular traditional closing, pay for that first year's insurance premium at full. so that it's paid for the entire year, and then that new escrow account in their name accumulates funds with each month's payment so that the renewal bill is sent to that loan service company at renewal, and it's paid, and everything works like it should. The renewal invoice is sent to the loan service company. It gets paid. Everybody's happy. The loan service company also sends out the annual 1099s, manages late payments, plays bad cop, sends payments to the underlying lender, and maintains all documentation. However, this is only done in about 40% of the transactions that we experience. Most times people try to handle the loans themselves. They're not equipped to. They don't track payments. They don't think of setting up insurance escrow accounts. They just assume that it's going to be paid by their underlying mortgagee. They don't think about what's going to happen at renewal. All these are just assumed that the stars are going to align, the world's going to work perfect because they want it to, and that it's never going to be a problem. Unfortunately, it's always a problem. But going back to our initial question, if there's a new escrow account created in the name of the buyer when the property is sold, isn't the buyer paying for insurance twice? Once in the underlying mortgage payment to the original mortgagee and now once in the escrow account in their name? Yes. And that's an unavoidable and inherent feature of purchasing property by a wraparound mortgage. It's almost like purchasing a car. You're going to have to buy tires and put gas in the tank. If you don't want to do those things, you shouldn't buy a car. This is part of a wraparound mortgage because of all the reasons we just mentioned. Now, that underlying escrow account that's the name of the original seller is going to continue to accumulate funds. What has to happen to that? Well, once a year, once every 2 years, somebody, the seller or somebody claiming to be the seller, that's outside the realm of the insurance folks, needs to contact the mortgagee, make sure that the paid in full receipt for insurance has been provided, and then request a reimbursement or refund from that escrow account to be sent back to the new buyer. That's just an inherent feature of wrap mortgages. Now, other people that aren't qualified or experienced will tell you that that's not the way it's done. I'm telling you that's exactly the way it's done. Anything else is wrong and can lead to future problems. Now, this is why, again, most wrap mortgages have a 2, maybe a 3-year balloon payment, so that this only happens once, twice, maybe 3 times before the loan is refinanced and the sellers are cashed out, the loan paid off, and everybody goes forward. Now, going back to this, the seller with the original escrow account should request an annual disbursement for his or her original escrow account and then refund that money to the new buyer because the new buyer, have paid for that insurance. Yes, it's going to require manual effort. Yes, it's a little bit of a hassle. But yes, that's inherent of wraparound mortgages. Again, it is what it is, and I keep driving this in because this is a conversation that we at Insurance for Investors have on a regular basis, that we go back and forth with the parties. But so-and-so said that this other party, well, no one know, I didn't have to do that last time. This is the way it's set up. Again, the insurance isn't going to change just because the parties in the transaction want the mortgage to. Now, here's some premium payment options for insurance. Unlike mortgagees, the insurance company itself doesn't care how premiums are paid as long as they're paid. They can pay, they being the buyer, named insured, can pay by monthly EFT draft, electronic fund transfer, from his or her checking account or recurring billing on credit card, depending on the company. That's fine. The insurance company doesn't care as long as they're paid. There can be a one-time annual payment in full from the buyer, or paid at full at closing and escrowed a new escrow account, as we've just discussed, with a loan service company. Again, the insurance company doesn't care. However, paid in full receipts, if required by a mortgagee or title company, cannot be provided for policies that are not paid in full and that are set up on installment billing plans. The premium has to be paid in full with a zero balance in order for this receipt to be issued. So even though it may be easier for the buyer to pay monthly because it lessens their money out of pocket and eases cash flow, that doesn't mean that's the right way to do it for the transaction. If they've got money to put down on the home, they should theoretically have money to pay for the first year's insurance as well. Now again, the insurance company versus title company. The insurance company doesn't care how premiums are paid, lender does. The lender wants to maintain control of policy payments to make certain that the subject property, which is the collateral on their underlying loan, is always fully insured at replacement cost values. RCT stands for replacement cost. The mortgage documents give the lender the legal authority to purchase what is referred to as force-placed insurance at a much higher cost to protect their collateral, and they add this cost to the balance of the loan. Meaning if they don't get proof of insurance on the property every year showing that their collateral is insured, they're going to purchase insurance to protect themselves. They have the right to add that amount to the outstanding loan balance, and that insurance is always 3 to 4 times more expensive than what it is purchasing it on the open market. All mortgages have an insurance clause within them, which very few people read. These clauses almost always, 100% of the time, require replacement cost coverage of the subject property, not actual cash value coverage, which is provided by most cheap HOA policies. HOA stands for Homeowners Policy Type A. If you'll remember one in our early slides, I mentioned that cheap insurance causes expensive problems and that price alone should not be an indicator of which policy you need to purchase. HOA policies are the worst type of policy that can be purchased for home or dwelling coverage, but they are very cheap. The reason they are very cheap is because they cover virtually nothing. It's actual cash value on the property and on the roof and any claim that occurs. Actual cash value is defined as replacement cost minus depreciation. That's not acceptable. That gives the lender the right to force place insurance. When they receive evidence of insurance, if they're paying attention and see that this is an HOA policy or that the evidence of insurance states actual cash value, they will contact the parties, require replacement cost coverage, which means issuing a new policy at a higher dollar amount, or they will force place coverage. That is something that all parties need to be aware of. So if you're purchasing cheap insurance now from someone that you can't believe you're getting it for $400 a year, this is why you're getting it for $400 a year. And the lender, again, may force place new insurance if their underlying insurance requirements in the mortgage are not met. Now, the problems with monthly billing, aside from the inability to issue a paid in full receipt as is often required, policies often cancel after being issued for non-payment of premium as well. The parties, the buyers purchasing a home in a wrap mortgage transaction, more often than not, I would say 6 times out of 10, payments will not go through due to insufficient funds in the account. Credit cards will be closed or changed, or there will be some other issue. The policies cancel for non-payment of premium, and then it comes up to the agency or agent issuing the policy to have to constantly go back and resell that policy and reinstate it and invest more and more time. Again, when there's $80, $100, $120 made on a policy, any money that may have been made from selling it get lost very, very quickly when paying the man hours, time, and cost of lost opportunity on other business dealing with issues such as this. Again, the lender and title company refuses to fund the transaction because a paid in full receipt can't be obtained, and there's added difficulty for the seller or loan servicer in making certain that the insurance is always in force. And reinstatements. As of the beginning of this month, August 1st, 2012, Insurance for Investors will only reinstate a policy one time if that policy has previously canceled for non-payment of premium, for all the reasons we've just mentioned. If a second non-payment cancellation occurs, it'll be considered permanent and we won't rewrite the account. And the simple reason for this is that we, along with other agents, brokers, simply can't continue to reinstate a policy 6 or 7 or 8 times for the same client that continually refuses or is unable to pay those insurance premiums. Now, there are 2 types of proof of insurance that are often asked for. The evidence of insurance. This is not the policy. This is a legal, formalized document showing that the insurance is actually in force at the time the document is issued, and it provides some details on coverages, the policy term, and named insured information. How much insurance there is, when it went in force, when it expires, and who the policy owner is. It does not provide payment or billing details. A paid in full receipt, which we've discussed many times, is a receipt showing that the entire premium for the policy term has been paid in full. It's often required by lenders and title companies at closing, and this receipt can only be provided if the premium has actually been paid in full for the entire policy term. In other words, no installment billing. So ultimately, it's the buyer's responsibility, because they own the policy and the home, to ensure that the policy premiums are paid as required. Insurance agents, as we've discussed in detail, are not responsible for chasing the money to keep the coverage in force. Now, let's talk a little bit about the types of homeowner policies that exist. This has a very direct effect on the parties in the transaction in the event of claims or losses in the future. Let's give an example of a mortgage clause or mortgage insurance requirement that we alluded to just a few moments ago. This is from SunTrust Mortgage, one that I looked at and pulled out of some of their documents. They require a minimum fire and extended coverage. All policies cover fire, lightning. Extended coverage are your other perils such as wind, hail, windstorm, things of that nature. They also require special form endorsement. Special form, sometimes referred as an HO3 policy, sometimes open perils, sometimes all risk. They're all synonyms for special form coverage. And it must be maintained at all times. So right there it tells you the exact type of policy it has to be purchased. SunTrust Mortgage must be listed as the mortgagee. Coverage must be equal to 100% of the insurable value of the improvements. The insurable value does not include the land. The insurable value does not include the equity or anything else. If the property burned to the ground, they're talking about what it would replace in current dollars, in material rates, labor costs, and soft costs to rebuild or replace that property. That goes back to replacement cost versus actual cash value, which we spoke about earlier. Insurance must be with a company or carrier rated B+ or higher by the best rating guide. The reason for this, strangely enough, some insurance carriers, specifically those that are smaller regional carriers, will become insolvent and go out of business after a major hurricane or catastrophe where they don't have the reinsurance or capital funds available to pay their claims. Having a B+ or better rating generally means that the company has a solid financial footing so that in the event of a large number of claims, they're going to be around to pay them. And a sufficient deductible must be carried, meaning you can't have a $100,000 homeowner's policy and want a $40,000 deductible to keep your costs down. It needs to be reasonable so that claims can be filed and paid for. Now here are your basic summary types of homeowner policies. This is certainly not an exhaustive, all-inclusive list to give everything in detail. This is a snapshot summary for those of you who are not insurance professionals to get the gist of the three types of policies. The HOA policy. This is the worst type of policy out there. It's the one that is normally used by most agents because it's cheap. And insurance is often viewed as a commodity, and in a wrap mortgage transaction, all the parties are looking at how much does it cost, and they want the cheapest thing out there to get the deal done. Here's why it's cheap. It's named perils only, meaning only those things specifically listed in black and white in the insurance policy are covered. If anything happens that is not listed in the policy, it is by default not covered. The dwelling, which means a physical structure, is only covered at actual cash value, no replacement cost. Same holds true for the roof. So any hail claim, it may be a $10,000 claim, but by the time the adjuster comes out and does the depreciation and all the claims math, that insured may get a $3,500 check to replace a $10,000 roof. Now everybody's upset because the property's damaged, can't be replaced, they don't have the money, and then the finger pointing begins. Why did you sell me this policy? Why didn't you tell me, shoulda, woulda, coulda? Personal property, also at actual cash value. Burglary, theft, fire, anything happens, all the contents inside that house have actual cash value only. Water damage is not covered, so burst pipes, leaking appliances, none of those things are covered. Vandalism and malicious mischief, also not covered. The HOB policy, homeowners policy type B, is the most common type policy issued in the state of Texas. And it's the most common type policy issued by your, shall we say, well-advertised, well-known, well-branded captive companies. It is also a named perils policy. However, the dwelling is insured at replacement cost. The roof is at replacement cost. However, personal property is covered at actual cash value still, unless there's an actual endorsement or change added to the policy for more premium, changing that to replacement cost. Water damage may be added in most cases, but it has to be added to the policy, and it does include vandalism coverage. Now, the best type of policy, that special form coverage we mentioned earlier, is a HO3, homeowners policy type 3, also referred to as an HOC, also referred to as open perils, also referred to as all risk, also referred to as special form. It goes by a lot of names. The dwelling, the roof, and personal property all covered at replacement cost coverage. Water damage, vandalism, everything is included, because the way this type policy works, everything is included and covered unless the policy specifically says it isn't. Whereas the other two, nothing is covered unless the policy specifically says it is. So that is very, very important to be aware of when purchasing insurance. Now let's talk about these insurance premiums that are the topic of all transactions. Premiums vary tremendously. As stated at the very beginning, they are a factor, but they should never be the factor. Why would a buyer invest the down payment of 3%, 5%, 10% or more to purchase a home only then to purchase inadequate or poor insurance to protect it? Just being blunt and straightforward, if the buyer can't afford to pay for the annual insurance premium of $800 to $1,000 or whatever it comes out to be, which is a very, very small cost compared to the monthly loan payment, appraisals, and everything else, then why or how is she purchasing the home in the first place? You shouldn't save a dime on cheap insurance to lose $1 later when a claim occurs. You just saw the various policy types out there, and you can extrapolate yourself some of the type of issues that may occur in the future. So the types of policy interests. Now we're going to talk about the 4 positions in an insurance policy, which are often confused and cause problems as well. The first is the named insured. The named insured is the person that or parties that own the policy. They're also the owner of the property. The seller used to own the property, but when that wrap transaction closed, he or she transferred equitable title and possibly legal title to that new buyer. Even though the seller was the owner, he or she is no longer the owner. So the named insured owns the policy and the property. This is the party that's named on the insurance declarations pages and other documents. And a declarations page is basically the page of the insurance policy that declares what coverages exist under that policy. This is the only party allowed to make any changes whatsoever to the policy. Add coverage, remove coverage, file claims, cancel the policy, receive any type of refunds, etc. They're the only ones with legal authority to do so. They must have a direct insurable interest in the property. We went back to the concept of insurable interest earlier in this, and they are the party to which the insurance company and agent have a legal duty. An additional insured. This is very, very misunderstood. Non-insurance professionals and even many people that are licensed insurance professionals assume that additional insured means you're also insured on the policy, just like the named insured party we talked about. It's just you're an and that too type party. That is not true. An additional insured has a liability only interest under the policy, meaning if that home burned to the ground, the additional insured is not going to receive any funds whatsoever. However, if there is some type of litigation involving the property that the additional insured may get involved with because of their ownership interest or sales interest or whatever, they may have coverage under the liability portion of the property for their legal defense, but that's it. They are usually not a loss, well, in fact, they're never a loss payee or mortgagee, which we'll talk to in the next 2 slides. They must have some type of insurable interest. You can't just add somebody on a policy as an additional insured because they want their name there. They have to have some sort of interest. And there are no benefits or communication for or of property claims. Now, the loss payee, this is, again, a very misunderstood term. A loss payee is a third party to which payment is made in the event of a claim on the subject property. Payment is made to or in addition to this party rather than the named insured. An example would be you have a bank that is your mortgagee. A hailstorm comes along and it's going to be $15,000 to replace your roof. When that claim check for $15,000 is made out to whoever owns a policy, it's also going to have the name of the mortgagee listed on that check. The reason for that is the loss payee, their loan is being collateralized by that property. They have a legal right to ensure that that property is replaced in its condition prior to the loss because it's securing their loan. This ensures that they're able to endorse over that check, manage the claim payment funds, and ensure that repairs are made. They also, loss payees, receive notification of the policy status on a regular basis. Whenever there are major changes made to policy coverages, if there are late payments, notices of cancellations, reinstatements, they automatically get a copy of all the letters that are sent out to the named insured policy owner. Mortgagee. This is the fourth party position or fourth policy position that gets confused. A mortgagee is a lender who holds an actual mortgage document on the property. A mortgagee is automatically a loss payee. So if you're a mortgagee, you're automatically by default considered a loss payee. Now let's understand what a mortgage document on the property means. It means not just a promissory note. Unless you as a seller have a promissory note outlining the repayment terms, interest rate, loan amount, amortization schedule, all those things actually secured by a mortgage document giving you the legal authority to force place insurance, foreclose on that particular loan in the event that the promissory note is defaulted on, etc. Unless you have an actual mortgage document, you're not a mortgagee. You're just somebody with an IOU on the property. And a mortgagee also has a legal right to force place insurance if a lapse occurs. So if a seller is a mortgagee to the buyer, they, by the mortgage document they have, depending on how it's written, should have the same legal rights as the mortgagee had with them when they own the property. It's enough to make your head hurt a little bit, isn't it? We're going to talk a little bit about credit, insurance scores, and insurance premiums now, because this is, again, another issue that often comes up with wraparound mortgage transactions regarding the cost of insurance and the availability of insurance. First of all, let's talk about what an insurance score is and what it is not. An insurance score is a numerical point system based on some credit information for the individual or individuals purchasing the policy. It's based on such things as payment history, collections, past bankruptcies, outstanding debt, types of credit, length of credit history. Why? Big question comes up. Why does my credit score have anything to do with getting insurance? Because the insurance industry is an industry that runs on statistics and actuarial data. And it's been shown that individuals with lower FICO or credit scores generally pose a higher potential insurance risk. There are numerous studies out there that show that people who are responsible with their money, pay their bills on time, have higher insurance scores, tend to be more responsible with their homes and vehicles. They take better care of them. If an issue occurs and it's a $1,500 repair, they'll just pay it and get it done and maintain their home rather than filing a claim and paying a $1,000 deductible so they can get $500 back from the insurance company. So credit scores are, like it or not, an indicator of potential insurance risk. However, an insurance score is not the same as a credit score. Lenders use credit scores to predict the likelihood of debt repayment. You want to get a credit card, you want to get a loan, I'm going to look at how you've paid your bills in the past to determine whether or not I want to extend credit to you. Insurance companies use insurance scores which use some select credit data to help predict the probability of an individual's likelihood to have losses and file claims. Other things that come into insurance scores are prior claims history, possibly the geographic location of the property, age, gender. There are other non-credit related issues that are considered in insurance scores. Now, insurance scores, like it or not, are used by most standard and captive insurance companies. So captive companies are those well-branded, well-advertised companies that you see on TV all the time. Standard companies are those companies like the ones I just mentioned that are in-the-box insurance. It's easy to rate online. They deal with people that present average risk. Some non-standard companies may not use insurance scoring. Non-standard companies being those companies that may offer policies with lesser coverage, or they deal with higher risk individuals or people with past claims or lower credit scores, FICO insurance scores. But they offset their risk of not using insurance scoring by automatically issuing policies with a higher base rate for coverage and limiting the coverages on their policy. So they'll generally offer a lesser policy for a little bit more money. They specialize in poor credit or higher risk clientele, And more often than not, these companies, again, offset the risk by only offering those basic HOA policies that we've talked about with actual cash value coverage. That's why you go to these non-standard companies that are smaller or regional, and the insurance is so cheap, and the parties go, yeah, that's what we want to do because it doesn't cost very much. Again, there's a reason. There's no such thing as a free lunch, and there's a reason that insurance is cheap. Now, it's important to know that agents such as myself never, ever see anybody's credit. We never see it. All this happens in the background with the software and the rating systems. All we see is an insurance premium. We don't see anybody's credit. We don't pull anybody's credit. And when insurance scoring is used, it does not count as an inquiry on anybody's credit report. It is a soft hit, no different than if that person were applying for a job and that employer looked at their credit to make sure that, that there's nothing they need to be aware of. So it does not affect FICO scores or drop anybody's scores, and it counts as a soft inquiry, not as though you're actually trying to get credit extended to you. Now, you've heard me talk about carrier eligibility, underwriting guidelines, and what we refer to as appetite. Let's go through these and how it affects wrap insurance. Common underwriting issues are situations in wraps where there are more than 3 mortgagees. The reason for that is because that presents a higher potential of moral hazard to the insurance company. Moral hazard, think of arson. I've got 3 mortgagees. I'm never going to be able to pay them all off. I'm upside down on this house. There's a higher likelihood of something such as an intentional claim or arson occurring because of that than if there were just a single mortgagee and one entity with debt service. So policies or homes with more than 3 mortgagees are going to be a higher risk. Severe history of losses and claims. Generally for the last 5 years is the snapshot of time that insurance companies look at. Obviously, somebody that hasn't filed claims or that maybe only has 1 claim from hail is going to be a much better risk than somebody that's had 5 claims over the last 5 years for everything under the sun. Those people are either going to be non-standard or their premium is going to be much higher. Poor insurance score, we just talked about, because there's going to be a high risk of future claims. Lack of prior insurance. Same thing. The insurance company's going to look at this and go, well, you've owned this home. Why didn't you have insurance on it, and why do you need insurance now? Did a hailstorm come by? Did something happen at the house where now you want to purchase insurance? Wait 3 weeks and say, oh, I just got my policy and look at what happened. Now I need to file a claim. So lack of prior insurance kind of raises the antenna for insurance companies as well, and that's a risk factor. As well as the property characteristics or the trampolines on the property. Virtually no insurance company will issue coverage for a property with a trampoline because of the liability issue of children, neighborhood kids coming over, jumping on it, getting hurt, all kinds of stuff. Properties that have aggressive breed dogs. We all know the pit bulls and Rottweilers and Doberman Pinschers and Akitas and other types of dogs that are on the common aggressive breeds list. Or properties that present higher risk due to the property's age, its construction type, meaning poured concrete, exterior versus solid brick construction versus masonry versus stucco versus extruded insulation, etc., as well as the property's maintenance condition. Insurance companies want to insure good risks. And a lot of the documentation that is going to be required, not by all companies, but we see becoming requested more and more often at this point, is the wrap mortgage agreement. Some insurance carriers are now aware that wrap mortgages are happening, and they don't mind issuing the coverage, but they want to see and have in their files something showing that this property is actually transferred. Doesn't mean they're sending this to the mortgagee, but in the event there's a claim or a policy change or they get audited, they will often want some type of closing statement, HUD-1, something showing that the property is transferred. They'll still issue coverage, they just want it for their files. The 1003, I meant really to put a HUD-1 there. The power of attorney, if the coordinator is dealing on behalf of the buyer, we at our agency may want that, and well, we will want that because of our duty and responsibility to the named insured. And this is a big one, fully signed insurance applications and associated documents. Most parties, when insurance coverage issued, will send out evidence of insurance, and then the assumption is, well, it's all done. I don't have to sign any of this stuff and send it back. Not true. We as insurance brokers and professionals need those signed insurance applications and documents back. Our files get audited. If claims occur, we need to have signatures and proof that this policy was issued and accepted as it was issued. These are something required. If we do not get this documentation back, it may lead to inability to issue coverage. Normally, you'll hear the term binder. A binder is basically when a policy has been bound or placed in force for a period of time, normally 30 days, which allows that window of time to get back all these documents. If those documents are not received, that binder may expire and that coverage ceases to exist. It can lead to notices of cancellation being sent out because this information hasn't been sent in as required, and an inability to reinstate coverage. Now, here are the two most frequently asked questions that we have. And then the presentation here will come to an end here in just a couple of moments. One, why can't the seller simply transfer his or her policy to the new buyer? Well, can't they just give me their old policy? No. Insurance policies are not assignable like real estate contracts are. A new policy must be purchased in the name of the buyer. The reason for this is simple. That insurance premium was underwritten and designed for the party purchasing that policy, not for somebody else coming in later. So a new insurance score must be reviewed. The property must be underwritten for coverage at the time, its current age, maintenance condition, and other factors that come in. Insurance policies cannot be assigned like real estate and other types of contracts. It just simply can't be done. And secondly, the most common question, can't the buyer just have his name or her name added to the seller's policy so that the mortgagee isn't made aware we don't have to get new insurance? Again, no. The seller has transferred title and no longer has an insurable interest in the property. And the seller's policy is no longer valid and enforceable. Period. End of story. Also, regardless of the insurance company, it's not possible to just add another name to an existing policy. In addition, the seller probably had a homeowner's policy in place. Well, a homeowner's policy is a policy issued and intended to cover owner-occupied residence. The seller is no longer the owner-occupant of that residence. Therefore, the eligibility guidelines for that type of policy no longer are in force. That policy is no longer eligible. Again, the buyer is going to have to purchase a new policy, and there's simply no way around it. Well, that concludes the presentation on insuring wraparound mortgages. You see our brokerage information here, 800-299-8994, then of course our website, insuranceforinvestors.com. We're very familiar with wrap mortgages. We work in a number of states, and we'll be happy to answer any questions that you may have. We hope that this has answered some of the questions that you had before investing your time listening to this. And should you have questions, concerns, or need assistance, please feel free to contact our offices